Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the complicated financial documents companies put out there so you don't have to, especially when those documents hint at some pretty wild financial maneuvers. Today we are diving into an S-1 filing from APPlife Digital Solutions Incorporated. This filing is essentially a company saying, hey SEC, we want to sell some more stock, and here is why you should trust us. But sometimes these filings reveal much more than the company intends. Stick around because we will break down their financials, their risks, and what this filing really means for Apple. DS. Before we dive in, if you appreciate getting straight to the point insights from corporate filings and want to understand the real story behind the numbers, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings further, so join us there. This is an amendment to a registration statement. They filed it on the 16th of December 2025. It tells us they are offering a massive amount of common stock, a whopping 1,742,097,698 shares. And that is not all, they are also registering stock underlying warrants, convertible preferred stock, and convertible debentures. This is a big complex offering. Let us get to the meat of it. APPlife Digital Solutions Incorporated. The company operates in the aftermarket automotive parts e-commerce space. Think suspension, lift systems, and accessories for Jeep truck and SUV owners. They acquired Sugar Auto Parts Incorporated in June of 2025, which seems to be their main operational engine. Now, they are telling us they are a development stage company, which means they are still trying to get their business off the ground, and they will need a lot more money. Now, let us look at the money side of things. For the 3 months that ended on the 30th of September 2025, they pulled in revenue of $464,172. That is not a lot, but it actually grew significantly. They say this growth was thanks to tech upgrades on their e-commerce platform, making more products available and better marketing. Their cost of goods sold was $359,148. That means their gross margin, which is what they have left after paying for the products themselves, was about $105,000. They are spending a lot on operating expenses, though, $467,966 in that same 3-month period. This led to a net income of $96,322 for that quarter. That is a positive sign, folks. But let us rewind a bit to the year that ended on the 30th of June 2025. Things were different there. They reported revenue of $315,130. That is even less than the third quarter of 2025. And to sell those products, they had total operating expenses of $246,137. The big story here, though, is their net loss for that period, which was a hefty $997,763. Yes, a big loss. That is why when you look at the balance sheet for the 30th of June 2025, you see total assets of $2,832,751, but total liabilities of $3,644,529. This leaves them with a stockholders deficit, a negative number of $811,778. This is a classic sign of a company trying to grow very fast but not yet profitable. And here is a really important piece of information. Their own auditors are saying there is substantial doubt about their ability to continue as a going concern. This means they are not sure if the company will be around in the near future without more funding. They have had recurring losses and negative cash flows from operations since they started. They are heavily reliant on debt and equity financing to stay afloat and expand. This is a serious warning sign for any potential investor. They acknowledge that while the automotive parts market is big, their ability to grab a significant slice of it might be limited. Their growth strategy depends on introducing new products successfully. But here is the catch: they will need more capital, and that capital might not be available on terms that are good for them, or maybe not available at all. This could really hurt their business. Building a strong brand is crucial for any e-commerce business. APPlife Digital Solutions knows this and points out that they might not succeed in doing so. Competition is fierce and many of their rivals have deeper pockets and more brand recognition. A weak brand could mean losing customers, and that directly impacts their bottom line. And they are upfront about the speculative nature of investing in their company. They say an investment here is highly speculative. They warn that you could lose your entire investment. This is because there is no minimum offering amount, meaning they can close the deal even if they barely raise any money, and they have broad discretion on how they use the money raised. Let us look at their financing strategy. They have a purchase agreement with CS/Capital Master Fund LP. This agreement allows APPS to sell up to $15 million of their common stock to CS/ under certain conditions. The stock is sold at a discount to the market price, typically 95% of the lower of the daily volume weighted average price or the lowest trading price. This is a common financing method for development stage companies when they need cash fast, but it often comes at a steep discount for existing shareholders. Looking at the selling security holders, we see some significant players. Christopher Davenport, for example, with 567 million shares is listed. The Sadewasser Trust holds 140 million shares, and Mammoth Crest Capital LLC is also a major holder with 500 million shares. It is interesting to note that Michael Hill, our CEO, and Barrett Evans, our CFO, are managers of Mammoth Crest Capital LLC. This means they have voting control and investment discretion over a large chunk of company shares. Let us quickly glance at the balance sheet as of the 30th of June 2025. We see that $2,696,018 is tied up in goodwill. Goodwill is basically the premium a company pays over the fair value of a business's net assets when it makes an acquisition. It represents intangible assets like brand reputation or customer relationships. In their case, it seems to stem from the acquisition of AP4 LABC LLC. The company is carrying a large amount of goodwill relative to its other assets and its current cash position. So what is the big picture here? APPlife Digital Solutions is a high-risk, high-reward play. They are in a growing market, automotive e-commerce. They have managed to acquire assets and technology through Sugar Auto Parts and AP4L. They have a plan to grow through marketing and acquisitions. However, their financial health is precarious. They have significant accumulated deficits, recurring losses, and their auditors have serious doubts about their ability to continue operating. Their reliance on dilutive financing like the CS/purchase agreement means existing shareholders will likely see their ownership stake shrink. The sheer volume of shares being registered also suggests a future where dilution will be a constant concern. In conclusion, APPlife Digital Solutions Incorporated is a company focused on growth, but operating under significant financial constraints. Investors should be aware that this is a speculative investment with a high probability of losing their entire investment. The path forward for APPLDS will depend heavily on their ability to secure further funding without excessively diluting existing shareholders and to aggressively grow their revenue and achieve profitability. The automotive aftermarket is a tough business, and only time will tell if they can carve out a successful niche. Alright, that is our breakdown of APPlife Digital Solutions Incorporated's filing. What is your take on these numbers and what they signal for the company's future? Do you think they have a shot at success, or is this too risky of an investment? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. And don't forget to check out the Discord community linked in the description below for more in-depth discussions. Thanks for watching, and we will see you next time.